Good morning, everyone, and welcome to this webinar. And thanks for sharing your precious time on this morning. And hopefully we will do many more webinars because every day it's talking about ChatGPT now. Hopefully will not be replaced by the robots very soon. And today I'm joined by my colleague Shan, and she's senior manager in our firm, and we're gonna co-present this webinar for all of you. Hopefully we will learn something together. And Shan, would you like to say hi to everyone?
Hi, everyone. Welcome to the webinar.
Okay. We have a few housekeeping rules just at the beginning. If you have any questions, we love to hear. You can type in the chat box. And we have my colleague, they will raise the questions at the end of the this webinar. Hopefully we have like 10 to 15 minutes so we can answer the questions in the end. Also, we have a survey. If you have any thoughts, would like to hear some different topics, let us know, and we love to hear your feedback. Also, we have live transcript. If you would like to turn it on, hopefully you will capture my accent. Okay, so without further ado, let's look at the agenda here today. Basically, we're not talking about any investments or advice on how you can get, maximize the benefit or return. Here, we want to point out some cross-border tax issues on these popular saving plans, pension plans, mutual funds, or investments through your corporation or trust. We're gonna briefly touch base a little bit on real estate investments. And as you know, we have different webinars to cover this real estate in depth or any other like tax planning for estate tax, stuff like that. So we'll just briefly touch on that. So Shan, I'm gonna let you introduce maybe the most popular question, which is TFSA saving plans, because it's popular in Canada, it's not taxed. So there might be some US tax issue to watch for. I will let you to run that.
Thank you, Cooper. So our main focus today is on investing strategies for US citizens or resident in Canada. Because they are in a unique situation here that they are taxed on worldwide income in both the Canada and the US. So we'll need to watch out for some issues here. I'll begin with the first most common questions asked actually in this topic, which is the Canadian tax-free savings account, TFSAs. And as the name suggests, the earnings from it is tax-free in Canada, but it is not in the US. So we often get this question whether a US person should hold a TFSA. And the question really comes to whether the US person can use TFSAs to their tax advantage. And remember, your goal is always to reduce your overall tax. So your overall tax paid to Canada and the US for US citizens living in Canada. And generally, your Canadian tax will always be higher than your US tax. Like for example, for investment incomes, there are some type of investments, for example, long-term capital gains or qualified dividends. US tax rate is maxed at 20%, but Canada has a much higher rate on those income. So to use this TFSA to your advantage, What you could consider is also have a non-registered account with investments that fully taxable in both countries. Then your Canadian tax paid on the investment earnings in those accounts to be enough to cover your US tax on the earnings in both the non-registered account and the TFSA account. And the other reason we often see that US persons should not hold TFSAs is because they were advised that they have to file IRS forms related to foreign trust. So IRS Form 3520 and 3520As. And they are very complex forms, so it takes a lot of time and fees to prepare them. Now, TFSAs are trusts under the Canadian tax law. However, it's generally the owner, because the owner has exclusive ownership and discretionary power over it. It's generally not viewed as a trust for US federal income tax purposes. So you should not be required to file the foreign trust reporting. So it's just as a general investment account in the US. Now you do have to pay attention to the mutual funds and exchange traded funds held within the US in the TFSAs, because they may have some negative attributes to it. And we'll discuss them in more details in one of the following sections.
That's great, Shan. Just a little addition, you talk about the TFSA, the passive income generally is lower, or in US, that's mainly because, probably because the US citizen resident in Canada, they're not subject to any US state level tax. So only the federal US tax, which is, let's say, 20%, and the plus 3.8%, we call the net investment income tax. So that's roughly about 24%. It's lower than Canadian tax rate. So it's fine. You will not get double taxed because you have enough Canadian tax. You don't have any Canadian tax, sorry, to offset that. So that's not good. That's one reason you mentioned. Secondly, you mentioned the foreign trust issue. This one is still a little bit of controversy, but it's at the beginning, and the TFSA was new. It was not covered by the treaty, the new protocol back in 2007. So TFSA came up around 2014-ish. So I think this is a new issue. RS or US Treasury, they don't have any specific guidance. So at the beginning, lots of people filed 3520 and the A to treat it as a trust just to be safe, because those two firms can lead to, let's say, 20 grand US penalty every year. But recently, I remember there was RS appeal office, the kind of ruled in favor of the taxpayer to treat it as just a regular investment account. It's good move, but there's not much authority to quote from there. So overall, I feel for US citizens, there's not much advantages to hold TFSA. So that's just some addition to Shan's thoughts. Do you agree, Shan?
Thanks, Cooper, for the additional insight.
Yeah.
It definitely depends on the client situations as well.
Okay.
And I'll just touch a bit on the tax-free first home savings account. This is actually a new account that's for the Canadian residents save money to buy their first home, where they can basically accumulate their income tax-free in that account. So it's very similar to the TFSA account. I believe it's effective April 1st, 2023. And from the US tax perspective, the treatment is essentially similar to TFSAs, where all the income generated within the accounts, interest, dividends, capital gains will be taxed in the US.
And it's also, like you mentioned, any investment underneath will be reviewed as like flow-through type of investments subject to PFIC reporting you mentioned here if it's held in mutual funds. So we're going to talk about more detail later.
Yeah,
so,
yeah, definitely.
Yeah, what about the Roth IRA you put here? Yeah.
Yeah, thank you, Cooper. So for Roth IRA, it is tax-free in the US, but not in Canada unless you make an election. So this election should be filed in the first year you move to Canada. And if it's late, you could write to the competent authority to ask for a late election to be done. Talk to your advisor on that. And also you cannot contribute to the Roth IRA during your Canadian residency period. Otherwise the election is not valid. Then any income from the Roth IRA account is taxable in Canada. So like we said, all the interest, dividends, capital gains, those investment income. Okay,
that's right.
So now,
yeah, Roth IRA is a US version of a TFSA. The contribution is from the after-tax money, but any income growth would be tax-free when it's distributed in the future. Once you reach some age, so that's great. So generally for people who already live in Canada, there's make no sense to open any Roth IRA. It's more for a scenario that people worked in the US, but then they moved to Canada, but they inherited our account still there. So they need to do some investment decision whether to still carry on with that or they want to liquidate and pull the money to Canada. There will be some issue for the rollover. We're going to touch base a little later.
okay, now I'll pass to Cooper to talk about the RDSPs.
Yeah, this is a registered disability saving plans. It's very similar to those RESP for educations or for even for TFSA. Because under the US tax rules, if you set up a trust, but meantime you as the trustee have enough power to contribute for all of the control the decisions making in regard of investments or distribution. Sometimes you put yourself as one of the beneficiary. So US grantor trust rules will said, hey, this is actually just every decision you contribute the money, you control it, you enjoy the benefits. So we're gonna disregard this trust will be treated as disregarded entity for income tax purposes. That means any income growth every year will be subject to the US tax. But in Canada, you don't pay any tax until the future distribution is made to the beneficiary. So there will be some income mismatch. Also, the foreign tax credit will not be available because in the future, in the most often cases, the parents set up disability plans for the kids. So the kids will receive the income in the future. They will pay the tax on the tax portion of the distribution. Generally, the capped portion, the return of capital is tax-free, but still there's a portion would be taxable income. So RDSP, there will be some issue there. And again, if it's treated as a foreign grantor trust, then it's subject to the 3520 and A, that two firms' annual disclosure. Again, if you don't file timely, there will be some potential penalties to be assessed. So it's not good. Then in the US, there is an equivalent account called ABLE account. You can see here it's called Achieving a Better Life Experience Act of 2014. So this act provides a relief for families who have disability, disabled person. Hopefully none of our audience here have such a issue. But if you have such account in the US, you have been carried on before you move to Canada. Let's say this is something you need to watch for, because from a Canadian point tax, Canadian tax perspective, there will be some reporting issue to disclose such accounts as well. It's interesting to notice, between these two accounts, RDSP distribution is taxable in Canada, but for the US, all of the distribution will be tax-free if they are used for those qualified disability expenses. So you see here for US citizens living abroad, they don't have much tax advantage for to keep all of these accounts. You can say it's unfair because US citizens, they still file US federal tax return, pay the US tax, but they don't, when all of these legislations come out, they don't consider well about people living outside of the US. So this is about this. I will turn it to you, Shan, for some RESP I just mentioned.
Thank you, Cooper. Yeah, like Cooper mentioned, the RESP rules are actually pretty similar to the RDSPs. So in the US and Canada has the registered education savings plan, and US has the 529 plan. They are pretty similar in the sense that you're saving for your kids' education. So for the RESP, the IRS, if your annual contribution limit is not met, the IRS no longer requires it to be treated as foreign trust going forward. And RESPs, you're receiving government grants and accumulating income within the plan. And it's similar to the tax-free savings account position that the income is taxable in the US on annual basis. And it's to the owner. So the person who established this RESP and contribute to the RSP. So you will have a similar problem with the TFSAs, that the earnings is not taxable in Canada, but taxable in the US. Okay, and one of the solutions we could think of is if you are a US citizen, but married to a non-US person, then consider the non-US spouse to open and contribute to the account. This way you will avoid the annual US reporting purposes, and also the from the income being taxed in the US as well. And there might be double tax risk, because when you receive distributions, when the kids receive distributions from the RESPs, they will be taxed on the government grant and earnings in Canada, while the parents, if there's US citizens, get taxed on the earnings as well in the US.
Yeah, that could also bring the gift tax issue, because RESP contribution by US parents could be treated as a gift to kids in foreign countries. So if it's exceed the annual limit, gift tax return may be required to be filed.
Thanks, Cooper. And for the US 529 plans, Canada is actually going to treat it as a factual Canadian resident trust. Why is the case? It's because the management and center of control of that plan are in Canada when the parents are in Canada. So even though the plan is established in the US, it is a Canadian residence trust and must file a trust return. And of course, on the trust return, you'll be reporting all the income earned in this 529 plan. So there is no tax deferred position here. And so this is really an extra reporting and double tax. So with this 529 plans, you need to really careful about it. If you're moving to Canada and having one, what do you want to do with it? It's probably a cost benefit analysis. You need to consider how much money the plan is making, what's the cost to dissolve this plan, what's the cost to maintain this plan in Canada. Yeah, so there is really, you need to think about the cost to do those things. And for example, if you have a plan for each child, and if dissolving the 529 plans cause a lot of penalties, you may want to consider merge all the plans into one plan to minimize the Canadian trust reporting. So yeah, so this is a really problematic area actually for US citizens.
Yeah, hopefully CRA will come up with some exemption filing like the IRS does. You know, they come out in 2020 with Revenue Procedure 2020-17. You put here if some conditions are met, no more foreign trust reporting. That's because the conditions could be some dollar amount limit or based on how many beneficiaries you have. Generally, a family less than 4 or equal, not less than 5, let's say 4 and less kids within the one family group, RESP, generally that will be exempt. If you have 5 kids under one plan, because of annual or the lifetime contribution, if you run out the numbers, that will be probably still be subject to foreign trust reporting. So it just wanted to clarify a little bit on that conditions. What does that mean? Okay.
Thanks, Cooper. Yeah, you do need to watch out for those conditions. So I'll pass to Cooper to talk about the pension plans.
Yeah, the pension plan is very popular, you know, it causes lots of headache when people work, you know, live in the US, but later on they may come back to Canada. And you know, the treaty covered well under the treaty, I think Article 18, they cover how to defer the tax in those qualified retirement plan. And generally in Canada, you know, RRSP or RPP, these two main type of Canadian pension plans, you can defer the tax, especially for the RPP, the employer-sponsored group plan. You can even exclude all of your personal contribution and the employer's contribution from taxable income from US tax purposes. Remember, US citizens is subject to worldwide income. So if there's not such relief provided by the treaty, all of these pension plans, the income, because it's not US domestic pensions, so the income would be generally taxable in the US. And this is some issue remind me about Australia superannuation fund, you know, that is like a hybrid pension plan with components for government social security plans, also employers sponsored plans, and your individual pension plan. It's kind of a mix it together, and there is a more complicated reporting issues for Australia superannuation funds. Depends on what stage or what's contribution history. So for Canada, RSP, it's not taxable in the US. You can defer the income. So you're gonna match the income reporting in the future when you get the distribution. Also, and you can match the foreign tax credit in that way. So what about the RPP? And the RPP, like I mentioned, you need to file extra the treaty disclosure the firm usually requires you to disclose the beginning balance or what's the annual growth, how much contribution. It's just like a full disclosure, then you're exempt for the foreign trust reporting. Also, you can claim for the deduction of the contribution and defer the income. Let's go to the next slides. I think there's some talk about US pension plans, individual retirement plans, and also the 401k is equivalent to the Canadian RPP if it's sponsored by the employer. Generally, you don't get much deduction in Canada, but distribution will be taxable in both countries. So that gonna match the income and foreign tax credit. Canadian taxes usually is on the full distribution, not just the income. Remember, in the US, you contributed, that's your capped portion. When you get the money back, a portion of the distribution, let's say monthly or annually, that consists of a portion of a return of capital, which is not taxable. So US only tax on the income. I think in Canada, there are some specific rules. Say if you can track those contributions, there will be some relief. They're gonna match the US reporting, only taxed on the income. I mean, all of these, the IRA, 401k, Roth IRA in the US, sometimes they allows you to contribute after tax money or taxable deductible money. So there is some contribution history you need to track, especially when you roll over from one plan to another plan. You may lose those previous records. So this is something, if you move from the US to Canada, you would keep the record for the future reference so that you can track the income to make sure which one is taxable, which one is non-taxable. In the real case, just like RSP, sometimes you don't have the clear contribution history record. You would have to come up with the estimate to the best of your knowledge for reporting the taxable income or not. And also for rollover, I just mentioned, if you move from the US to Canada, you already have those RA or 401k or Roth IRA account in the US. You might want to consolidate those for whatever reason, let's say for foreign exchange rates concern, or you want to minimize your investment or the management fees. You want to consolidate those, move to Canadian RSP. So there is some limitation and the procedures you need to follow. There are some ways to treat it as tax-free rollover. It's not tax-free, I should say, still tax defer. You get the income. You're gonna be taxed at the lump sum at income. Then you get the deductions. However, there are some details about US withholding tax or US early withdrawal penalty tax. And for that part, you may need to come up with some cash to top the contribution so that you can get the full deductions. There's some timing. There's some direct rollover transfer requirement. All of these, you need to consult your tax professionals and your investment professionals so that they can work together, make sure for the tax treatment in Canada, that will be a tax-free rollover. It's very important.
Yeah.
I'm gonna turn to you, Shan, for the next slides.
Thank you, Cooper. Yeah. So the other, I think, very popular topics coming up in these webinars is mutual funds and exchange traded funds, so ETFs. So these two funds are considered passive foreign investment companies known as PFICs. Now, PFICs includes a whole lot of other things or corporations as well, so it's not really exclusive here. What is a PFIC? So a PFIC is a non-US corporation that either has 75% or more of their gross income is passive, or their average assets are 50% or more passive. Now, the question we often get is mutual funds and ETFs corporations, right? So because they are a trust in Canada, they hold in the trust and they have advisors managing those funds. However, under the US tax law, a Canadian trust that's conducting those business activities is a corporation. So by default, they are non-US corporations. So anytime when you have a non-US corporation, you should take a look at the PFIC rule. So in this case, the passive income could include interest, dividends, capital gains. Those are common ones. Rents and royalties could also be passive as well. And that's one of the two tests. The other test is passive assets. So passive assets, investments, of course, is passive asset. But the other one that people often don't think about is cash. So cash is also a passive asset, even though it may be a working capital in the business. Right? For example, if you have service corporations that may collect a lot of cash, then once they are over the threshold of the average assets of 50%, then the corporation is actually a PFIC. And there is a rule that once it is a PFIC, it's always a PFIC. Now, Cooper will, in the following sections, may talk about some exemptions, but you do really want to watch out for non-US corporations on this PFIC rule. And the other questions we see a lot is some people ask, if I hold the mutual funds and ETFs under a corporation, can I avoid this issue? And the quick answer is no, because the US has this flow-through rule for individuals to report the PFICs, even though you hold them indirectly. So either through your own corporations, and as also mentioned earlier, the PFICs and their TFSAs, RDSPs, or ESPs, they are also all required to be reported by the individual owner. And note that this PFIC rule only applies to the US persons, US citizens, green card holders, or US residents, basically.
Yeah, so, Shan, that's great. Just a little, little exception for the mutual fund. I remember the IRS had a long list. They have a separate ruling about what kind of a mutual fund, Canadian mutual funds will be treated as PFIC for the US tax purposes. Most of the mutual funds nowadays are PFIC, except for some very old mutual funds they set up, let's say in 1980s, 90s, they have a list, a few of those. They said they're gonna be exempted. But anything after that, in the nowadays, let's say in past 10 years, 15 years, most likely they all will be treated as a foreign investment company, because every mutual fund unit is treated as a share of that mutual fund. So since the unit holder has limited liability for any loss of, any for these PFICs, then it's treated as a PFIC. That's not good. I mean, the tax consequences is not huge. It's more like the filings. You need to details calculations. You can talk about more on that, maybe on excessive distribution, the throwback tax, and the foreign filings.
Yeah. We talked a lot on how to identify a PFIC, but like, what's the problems with it, right? Well, one of the main thing is on the gain is prorated over your ownership period and taxed at the top marginal rate. So you're not going to get the capital gain preferential rate. So for example, if you bought a $10 investment in year one, and after 10 years, you sold it for $110. So you have $100 gain on this investment. But if the investment is a PFIC, under the US law, you're going to treat this $100 gain as pro rata over the last 10 years. And worse enough, you are going to pay interest charges on the deferred tax. Well, like, you want to argue that, I didn't defer the tax, right? I just sold it after 10 years. But sometimes the US tax law kind of rules against it. It's just treated that way, that you're deemed to have earned the investment pro rata over the last 10 years. And there are also foreign tax credit limitations as well. So we talked about all those adverse tax consequences here, and what are the solutions to it, right? I mean, one of the most common ones you would want to think about is investing in equities directly, not in PFICs, mutual funds, or ETFs. And you could invest in US mutual funds or US ETFs, as long as they are managed in the US, then they're not non-US corporations, right? But sometimes you do need, Canadian mutual funds. You want to diverse your portfolio. You couldn't do that, right, with the investing in equities directly. So what other solutions do we have? And one of them is actually the qualified electing fund, which is the QEF election. You have to do it in the first year of purchase on your US return, disclosing it. And with that election, you need to report the income as the funds earn income. Whether it's dividends or capital gains, it retains that character when it's passed through to you. Now, you don't always have this information if you are a small investor. You can ask for, your investment advisor for the statement, but I don't believe all the mutual funds have it. And the other alternative is called the mark-to-market election. Basically, for all funds that's exchanged in the stock market, you're deemed to have sold all your funds at their fair market value at the last business day of the tax year. However, the gain is still taxed at the ordinary income tax rate. And there is also the risk of double taxation, because you'll likely have the Canadian capital gain when realized, And then the US PFIC rules recognizing ordinary income as yearly as the stocks appreciate or depreciate. So so we don't use mark-to-market election a lot, actually.
So Shan, what if people don't realize the PFIC issue until, let's say, 3 years later after they bought the mutual funds? Then they want to make these elections.
Right. I mean, it's really strongly suggest you look at this issue earlier. When you bought the mutual funds, you could make it, then make it. If you want to make the election in the later years, there are a lot of nuances in terms of the distributions, the excess distributions, as Cooper mentioned earlier, to be applied in the prior years, and we can fix them in the current year and making that election.
Yeah, that's great. Another solutions we saw some client, they have 30 mutual funds in different investment accounts. By the way, any mutual funds hold under the pension plans, RSP, REIF will be exempt for PFIC reporting. So that's a good solution. If you want to put your mutual fund in the pension plans, you will not get this headache for reporting. However, we see many, they have 30 mutual fund investment. They're trying to diversify in a fantastic job from the investment diversification purposes. But then they realize they need to file 30, 25 firms for each mutual fund. I mean, one firm for each mutual fund. So every year you need to file 30 firms. That's a lot of paperwork. And for each fund, you need to look at the contribution, the date, the dividend dates, also potential the sales date. So then you calculate what is the excessive distribution. You use the private 3 years income to average. I mean, there's lots of calculation for each firm, so lots of issue. In that case, like you said, you may just want to invest in some stocks directly, like you buy the Canadian stocks, Suncor or whatever, Manulife, rather than or mutual fund. Also, you can consolidate. Sometimes in reality, it's hard to not invest any mutual funds. So you can keep a few to minimize, let's say 3 to 5. That is manageable for US tax reporting. It's much better than 20 mutual funds in total. So just throw some thoughts here. Yeah.
Thanks, Cooper. Yeah, I'll turn to you.
Okay, yeah, people say, hey, you talk about these, if I hold it, a mutual fund or all of these PFIC reporting, what if I put my investments into a private corporation, or you have a business in a corporation, you have lots of cash available, you want to do some passive investment in the corporate level, you don't get the actual distribution so that you can defer the tax. That's great. Or also, what if I have family trust? I got dividends income from let's say the operating co or holding co, distribute the cash to the foreign trust. I put my investment under the trust, saved for the future for other beneficiaries like a spouse, kids, whatever. So in this case, same thing, because first of all, for private corporation, like you explained, it could be a PFIC issue if you are not a majority, let's say a controlling shareholder. Let's say you have family business, you are just have 10%, 25%, and you are the US person, but the controlling shareholders, they might just Canadians. So this is a foreign passive investment income company. Let's say if you have lots of cash, not much hard assets, in that case, it's subject to PFIC reporting for any year's dividend income distribution. That's mean if you don't get dividends in 10 years, you just get one on the 11th years. Then generally, you would prorate this whole amount over the 11 years or past 10 years. They could throw back the income and calculate the tax on each year's income plus penalty, the interest charge. So that's not good. What if you're a majority shareholder, you're a controlling shareholder of a Canadian corporation here, but you are a US person, okay? So in this case, for passive investments, generally from the US tax point of view, they don't want you to defer the foreign income in the corporate level without any active business, So they're gonna say, hey, even though you did not get much distribution from the passive investments, let's say dividend interest, capital gain, rental property income, royalties, if you get this type of income, they're gonna treat you have received the income or treat it as your personal income right away in that year, annually on the annual basis for the US tax reporting. So you will not get a foreign tax credit because you did not pay any Canadian tax. However, for the US part, you are a controlling shareholder, they treat you that you have received the income. So that's for the passive investments. It's not good. We often call Subpart F income because this is governed by the Internal Revenue Code, Subpart F. So that's why it comes up with that name. What if you have a Canadian corporation? I don't have much passive income. I have active business, but maybe because it's small business deduction, I don't pay much tax for the corporation. Then you got caught by this GILTI tax. So this is a new tax under the Trump's tax reform back in 2017. So GILTI stands for Global Intangible Local Taxed Income. This is a separate topic. I don't want to dig into too much, but generally, even it's active income, active business income, but if you don't pay enough Canadian corporate tax, you still get caught by this. It ends up you're gonna pay a lot US tax as a shareholder. And the way in the US tax is for corporate tax, in Canada you paid, generally you cannot get tax credit for this US individual shareholder tax unless you make 962 election, section 962. So that's another topic. There are lots of calculation so that you can get some tax credit. So overall, you can see for the Canadian corporation, if you're controlling shareholders, you're still might be subject to a lots of US individual tax. Then what about a trust? A family trust, you want to shift the income. Generally, we mentioned many times, if you roll over the assets to the trust, you probably is one of the trustees. Also, you're one of the beneficiaries in addition to your family members or charities, So in that case, any income associated or attributed to any assets you contributed to the trust would be treated as your personal income. Then any mutual funds, anything like that, PFIC reporting will be still on you because the grantor trust is kind of disregarded, or you can call it as a flow through. So all of these will cause the issues. We mentioned for the PFIC, there might be a first year exemption that's available for some startup company. Let's say you set up a company, you got lots of cash as a contributions from shareholders, or you got a big loan from the bank, and but your business has not started yet to generate enough revenue. So in that case, there's some exemption there. It's very limited scope, but it's available. we talk about the passive income generated by your controlled foreign corporation, I mean, Canadian corporation here. There is a de minimis rules for 5% if the passive income is not more than 5% compared to the overall gross income of the corporation, then you can ignore the subpart F income rules. So this is just some issues I raised here, for potential solutions. And if you want, we can set up a meeting to talk with details, especially for private shareholders, So let's go to the next step. I think we need we only have 10 minutes left. We want to have a little bit time for the questions. So yeah, just really quick, Shan.
Yeah, so I'll just touch base quickly on the real estate investment. We're just trying to highlight the issue here because this could be another standalone webinar. So when you considering the choice of entities to hold the real estate, you need to consider the point is that you don't use one that's treated differently in Canada and the US. So for example, if the entity is a partnership in the US, but then is treated as corporation in Canada, then you could easily have a mismatch in terms of income recognition, how to use the foreign tax credits. Yeah, so those are the considerations when you thinking about the choice of entities to use to hold your real estate investment. There are also some differences in the principal residence exemption. Canada usually exempt the full amount of the gain in your principal residence, but in the US, depending on your filing status, there is a limitation, dollar limitation on the gains you can exempt. And the other thing we need to watch for is actually the foreign exchange gain loss, especially on lump sum mortgage repayment, actually. So a US person actually should report the foreign exchange gain loss between the date you borrowed out the mortgage and the date you paid the lump sum mortgage, because those are in Canadian dollars. And you're reporting US dollars on your US returns, then there might be a gain loss reportable. Okay. And also differences in depreciations for Canada and the US for rental properties. US depreciation is mandatory, but Canada, you can choose to use it or not. And the recovery period is also different. And then lastly is just a topic lumped in here. This is new for the underused housing tax. It's effective January 1st, 2022. So you may have this reporting obligation due April 30th, 2023 this year. Okay. I will pass to Cooper.
Yeah, this is a simple insurance plan, because in both countries, there's a very important lobby power, very large. So now in the tax law, you see insurance plans, it's always governed by tax law differently. So I just want to point it out, in Canada, people often buy those investment type of insurance plans, hybrid with life insurance. So strictly speaking, those does not fit to the US insurance definition. So be careful. Some investments in insurance in Canada is treated as tax-free or tax deferred for Canadian tax purposes, but might be tax-free in the US. So that's an important thing to learn. Also, you need to file a form for the US excise tax for 1% any premium you pay to the Canadian insurance company. Just watch for this. Very simple. Let's go to the next. Yeah, the next we talk about this, many different issues for investments. What if you said, hey, I have a Canadian spouse only, he or she does not carry dual citizenship. So can I do something to shift the assets? Generally you can, there's many consideration here, you can make the spousal loans, even though nowadays the prescribed rate is pretty high. Let's say it used to be just 1%, you can do more planning, you have investment return for 6-8%, so there you can shift 5 or 7% of investment to a spouse. However, with a 6% around that rate, it's not much beneficial anymore. Then if you do any, transfer, let's say a gift for the US citizen, you can gift, let's say 170 grand, rough number there nowadays, US dollar, you can give to a non-US spouse tax-free from high earned spouse to a low earned spouse. So then that's good for the US gift tax purposes. However, you may need to watch for the attribution rules in Canada if you do some tax-free gifts to your spouse or your family members sometimes. So that's that. The estate tax, this is the more long-term consideration, you need to think about US citizens living in Canada. Let's say if I were a dual citizen living in Canada, when I passed away, I need to file last year Canadian tax return, last year US income tax return, and the US estate tax. You at least need to file 3 tax returns. So how to claim or to report the income first? In Canada, it's capital gain from deemed disposition over nearly all of your assets, except for some rollovers to spouse. And for US estate tax, it's similar, generally 40% tax on anything about $12 million nowadays. $12 million can be reduced to half in 2-3 years. So this is something you need to consider. Overall, this is a different topics about estate tax filing stuff. We're here to help, and we know the details. And if you need any help, just reach out to us. And I think that's about it for all of the slides. So yeah, I mean, we'd love to hear your advice on how we can improve. And I know many of you have attended different seminars. We treat you as friends and family members, right? We saw your names often on the list. We love to have you here. And now I would love to hear any questions.
Thank you, Cooper and Shan, for the presentation today. There's a lot of information to be learned. We received many questions, but due to the limitation of time, we will try to answer some, and we'll follow up with the rest after our webinar. So the first question we have is, what are the advantages and disadvantages for the US citizen holding a TFSA?
Okay.
You want to go?
Thanks. Yeah, thanks, Janice, for that. I mean, as we mentioned in the webinar, as a US person living in Canada, your focus is really to reduce your overall tax, both the Canadian and US tax. And with the TFSAs, if there is no other reporting obligations, and any earnings from it will be tax-free in Canada. And we said in the solution that it really depends on your situation as well. But if you have an unregistered account, for example, with a lot of money in it and earning regular investment income, the Canadian tax on those investment income could be enough to cover the US tax on those TFSA earnings as well. So overall, you're not, double taxed. You're using that account to earn tax-free money in both countries. You do want to watch out for the mutual funds and ETFs and other PFIX reportings in there, because that will becomes a disadvantageous to you. Cooper, do you want to add anything on that?
No, I'd like to move to the next questions because of time limit. Like I said, we might need to follow up by separate emails for those questions. Thanks.
Thank you, Shan. The next question is, can a Canadian citizen living in the US as a US resident for tax purpose open a Roth IRAs or any IRAs? And if yes, is there any implication from Canadian tax point of view?
So I just want to clarify, Janice, the person is moving to the US from Canada?
The person is currently living in the US.
Right, so if you're living in the US, usually you are not a Canadian resident, but I mean, you have to go through all the tests on that. But if you are not a Canadian resident, you are not taxed in Canada on your worldwide income.
So in that case, it should be fine. Generally, you have filed departure tax in Canada, you cease the residency in Canada. Then if you live and work in the US, you're eligible for those US pension plans. But the issue will be raising up was, let's say, many years later, you decide to move back or retire in Canada. That will be some issue there.
Great.
Okay, one more last questions.
Okay, I guess the last question is, if a Canadian resident US citizen is still employed by a US employer, would you say is not advisable to contribute to 401k?
That's like a remotely working for the US company.
Yes, yeah.
Yeah, in that case, there are some tricky parts there. You're not a US resident anymore. And in Canada, generally, under the treaty, if you want to get a default treatment for Canadian tax purposes, you would have to be a US resident to provide services in the US so that you will be eligible for those US pension income deferred. So generally, I don't think it works out to maximize your tax benefits, but we can look into the details for a different type of situation, Okay, I think that's all for today. Thank you, everyone, for your time. I appreciate it. And we'll stay in touch. Thank you. Have a good day.
Thank you, everyone.